Have you ever thought you could maximize your income while living overseas, specifically in the Netherlands? Let's make an in-depth review of the remarkable tax rule that may dramatically affect your financial situation as an American expat in the Netherlands, the Dutch 30% ruling that's now been modified to a 30/20/10% rule over 60 months. This rule, greatly admired by expats, is a considerable tax advantage that the Dutch government provides to highly skilled employees enlisted from foreign lands. The essence of this rule is surprisingly simple. It allows 30% of your annual income, up to a whopping 233,000 euros, to be paid without any tax deductions. You heard right. A considerable chunk of your earnings could potentially be tax-free. This rule was fundamentally established to attract proficient foreign workers to the Netherlands. Its objective is to reimburse for the additional costs tied with living overseas, referred to as extraterritorial costs. Notably, if you're an American expat residing in the Netherlands, comprehending this rule could be crucial for boosting your income and orchestrating a robust financial future. It becomes even more attractive when you realize that it could potentially allow you to save a significant amount of cash. So, who qualifies for this rule? The 30% ruling is applicable to individuals who have been enlisted or relocated from abroad and possess distinct expertise that is in short supply in the Dutch employment market. However, there are specific conditions too. For example, the individual must have been residing more than 150 kilometers from Dutch borders for over 16 out of 24 months prior to their employment commencement in the Netherlands. Like any tax law, it has its unique subtleties and stipulations. Stay with us as we look into the fine details of the 30% rule. As an American expat, your financial journey doesn't end with understanding the tax rules of your host country. You also have to navigate the complex world of U.S. tax laws. While this might seem daunting, it's a crucial part of your finances effectively while living abroad. The U.S. is one of the few countries that taxes its citizens on worldwide income, regardless where they live. This means that as an American expat, you're required to file a U.S. tax return each year, even if you owe no tax. But don't panic just yet. There are provisions in place to help mitigate the risk of double taxation. The foreign earned income exclusion, for example, allows you to exclude a certain amount of your foreign earnings from your U.S. taxable income. There's also the foreign tax credit, which gives you dollar-for-dollar credit for the taxes you pay to a foreign country. And let's not forget about tax treaty provisions. These agreements between two countries can often provide reduced rates and exemptions from taxation in the country of residence. So, understanding both Dutch and U.S. tax laws is crucial for American expats in the Netherlands. The 30% ruling, a Dutch tax advantage, is particularly beneficial for highly skilled migrant workers. It might appear complex, but it essentially means that 30% of your salary can be paid as a tax-free allowance, considerably reducing your overall tax burden. However, certain conditions must be met to qualify for this ruling, such as your employer agreeing to apply it, you having specific expertise not readily available in the Dutch labor market. But with careful planning and a solid grasp of the rules, including the 30% ruling, you can navigate this financial labyrinth effectively. Let's look at how this tax advantage can impact your expat lifestyle. So, you might be asking, what exactly is this 30% tax rule, now modified to a 30/20/10% rule over 60 months, all about? Well, it's a distinctive tax advantage put in place by the Dutch government with an aim to draw in qualified international professionals to bring their expertise to the table in the Netherlands. This rule is a tax exemption that permits eligible employees to get up to 30% of their gross income, up to 233,000 euros annually, tax-free. Fascinating, isn't it? Before you start daydreaming about all the Dutch cheese you could buy with that extra cash, let's look into who this rule applies to and under what circumstances. In essence, this rule is crafted for expatriates who are recruited or relocated from abroad to serve in the Netherlands, particularly those who possess a certain expertise that is rare or non-existent in the local Dutch labor market. So, if you're a specialist in your field, you might be in for a delightful surprise. Moreover, to qualify, the Dutch tax authorities necessitate a minimum salary threshold. As an instance, in 2024, this salary requirement is approximately 40,000 euros, excluding the 30% allowance. But hold on, there's an additional criterion. You must show that you resided more than 150 kilometers from the Netherlands border for over 16 of the 24 months preceding your employment in the Netherlands, primarily to exclude daily commuters from neighboring countries. Now, what's the real-life application of this rule? The tax-free 30% of your income is seen as recompense for the extraterritorial costs you bear as an expatriate. This encompasses expenses related to housing, visits to your homeland, and even your child's international schooling fees. The best part about this rule is that you don't need to provide any proof of these expenditures to the Dutch tax authorities. Once your 30% ruling gets sanctioned, the tax-free benefit is automatically applied to your earnings. Now we've understood the basics, let's dive into its implications. On the surface, a tax break of up to 30% sounds fantastic, doesn't it? Let's dig deeper into the workings of the 30% tax ruling. The primary value to this ruling is the significant reduction in income tax, a boon for American expatriates. Living in a foreign country amplifies the value of every cent saved, and this ruling provides an ideal opportunity for it. Picture roughly 1/3 of your income tax-free. What significance does this hold for you? It translates into more disposable income, more money for investment, savings, and enjoying your stay in the Netherlands. This financial cushion can ease a smoother and more comfortable transition into living abroad, offsetting the burden of hefty living costs. Another excellent feature of this tax ruling: potential longevity. The duration is dependent on the individual situation, possibly providing extended periods of tax relief. But the benefits go beyond the financial scope. This tax ruling also encourages the relocation of highly skilled workers to the Netherlands. It's a win-win situation, benefiting both the expatriates and the Dutch economy. The nation benefits from an influx of talent, enhancing its competitiveness in the global market. However, despite the attractive benefits, it's vital to be aware of the potential downsides. There's always a catch, isn't there? As tempting as it may sound, it does entail strict prerequisites that need to be met. The regulation is solely for employees who have been hired or transferred from abroad by an employer domiciled in the Netherlands. Hence, if you're self-employed or secured a job post-relocation to the Netherlands, this may not be for you. You must also possess unique skills that are deemed scarce or deficient in the Netherlands. The Dutch tax office establishes this by scrutinizing your income. If you're under 30 years of age and hold a master's degree, your earnings must surpass €35,048 per annum, 2023, EUR 31,891, excluding the 30% ruling. If you're 30 or above or under 30 but without a master's degree, your annual income should exceed €46.107, 2023, EUR 41.954, again disregarding the 30% rule. Another stipulation is that you must have resided more than 150 kilometers from the Dutch border prior to your job commencement. This is to deter daily commuters from neighboring nations from profiting from the scheme. Non-compliance with these stipulations equates to being taxed like any Dutch inhabitant, with a potential income tax rate of up to 49.5%. Bear in mind, if your job or contract terminates, does the 30% tax advantage. This rule applies only for 5 years, and as of January 2024 is now restructured to trickle down from 30% the first 20 months, 20% then down to 10%. These changes apply to anyone applying for the tax break after January 2024. Employees previously approved for the tax rule will still see the benefits for the whole of 5 years. So, is the 30% rule a boon or a bane? The reply isn't universally applicable. It is heavily reliant on your personal situation. The biggest drawback is that your buying purchase diminishes with each trickle-down percentage, which can affect things like mortgage and debt payments. You must take these tax changes into account for proper financial planning. We've covered a lot of ground about the 30% tax rule in this video, so what's the bottom line? The rule certainly presents some substantial benefits for Americans living in the Netherlands, including a considerable tax break, relief on income and assets, and an eased process for license conversion. However, it's not without its downsides, like potential restrictions on investment opportunities and specific salary requirements. Here's a crucial detail to bear in mind. While we've given you a thorough overview of the 30% tax rule, everyone's case is unique. Therefore, it's always wise to seek professional advice before making decisions that could affect your financial status. Consider your own personal circumstances and financial goals. Are you planning to stay in the Netherlands long-term, or is it a temporary move? How will the rules shape your future financial planning? These are all questions that need thoughtful consideration. Remember, knowledge is power. Stay informed and make the most favorable decisions for your financial well-being.